find a way.
Derik, welcome, man. Thanks for being a part of this.
Hey, excited to be here. I've never been to Bristol, and it's an awesome city.
Yeah, so you live in Southern California?
Live in Southern California, from Pittsburgh, Pennsylvania.
Yeah.
Went to school in Ohio, so I've been in East Coast, Midwest, West Coast, but Tennessee is a great place.
Yeah.
Actually, a couple of the local bars yesterday after our event, just to see what it's like. It was a great time. There was some karaoke, and the energy was really high, so it was fun.
Yeah,
having a great time.
Yeah, it's a unique town. Downtown here it's just a great place. Like, this is the birthplace of country music.
Okay.
Country music started in downtown Bristol, and that's part of our identity. So,
you can feel the energy.
Yeah. So probably a lot more country music than in Southern California, but
there is not too much country music, but big fan. Kenny Chesney, Morgan Wallen.
Yeah,
I like those guys.
Yep, for sure. So, man, you've got a really interesting role in the real estate space.
Yeah.
And in the past couple of years, the lenders, the hard money lenders, have had a really important role in keeping the ecosystem going.
Absolutely.
And so I'm curious about, you've got this unique perspective where I assume you talk to guys all the time that are flipping houses and doing different stuff. So I think you have a really valuable perspective. Tell me how you ended up in this industry.
Yeah, it's interesting. But as you said, we're talking to hundreds of investors a month.
Yeah.
Through different channels and things of that nature. So it's really cool and we're investing all over the country. Mm-hmm. So you're hearing different markets, different strategies. People are trying to burr, people are trying to flip. Some people want to buy, turnkey rentals. So, and then some people want to try to do the short-term rentals and everything like that. So you're talking to a gambit of investors, and it's really interesting. And I'm sure we'll get into that.
Yeah.
But in terms of how I got going, Vontiv is a financial technology startup, venture-backed, led by two, incredible founders, Charles McKinney and Shreyas Vijay Kumar, who are very successful people. One, Shreyas from Palantir, Charles is from Freddie Mac and was head of credit risk there. They saw that there was a niche in this investment real estate lending market. The conventional space is pretty crowded. If you take like the top 20 conventional lenders across the country, they're making up like 90% of the lending market. If you take the top 20 lenders in the investor real estate lending market, they're still making up, the top 20 lenders, like 15 or 20% of the market.
Really?
So it's super fragmented.
Right.
And it's not been standardized, and there's not many companies that have been able to execute really well and be a consistent financial partner for investors as they kind of grow their portfolios. So Charles and Shreyas saw an opportunity there to create a technology and financing company in a space that needed it. So when I learned about what they were doing, I didn't know much about investment real estate. I didn't know a ton about real estate investing. I just liked the vision of kind of helping a company that was a cool startup that had some growth and momentum, and then helping, we're trying to go public and we want to be lending, tens and billions of dollars a year to real estate investors. And most of our business is repeat clientele. So I'd say 80 to 85% of our business comes back over and over to do more loans with us. And that's what we're trying to do. We're trying to play the long game and be, a long-term partner with them. So when I had the opportunity to come in and, help them build it and kind of take a fresh approach, because like I said, I didn't know real estate. I came from, enterprise software sales and other startups and things like that. So once I just started talking to investors, giving them, loans, becoming like a lending advisor is what we call our team. You really kind of hit the ground running. You learn a lot. So I've been doing that for about 2 years now, and I've done a ton of loans, had a lot of conversations, and we're growing really fast. So kind of a long kind of story, but that's how I got into it, and I love it. It's insanely nuanced, and all the different entrepreneurs in this space, and then there's a lot of family businesses, husband, wives, husband, dad, son, things like that. It's pretty cool to see these people building like generational wealth.
Yeah, and to play such a crucial role in that gotta be satisfying.
For sure.
Yeah.
For sure. Yeah. We just want to be reliable.
Yeah.
You know, we don't want someone to get into a deal. We're going to lend to them, and then all of a sudden we back out. Or, you know, we try to explain up front, this is where we live. This is what we can lend on. These are our terms. And then the investors kind of, maybe sometimes they build their strategy around that, knowing that, you know, Vontiv or whatever brand that they're using, the Vontiv mortgage experience is going to be there for them.
Yeah.
So that's really important to us.
Yeah. When did you know you wanted to be in sales?
When did I know? I think once I did a job that wasn't sales and I saw that what you put in isn't what you get out, and you're kind of just doing like no, it doesn't really matter. You can be okay and you're still doing your job. Once I saw in sales where if you work really hard, or if you're really good, or if you have, you know, some natural instincts and abilities to help people and give them a product they need, you can excel, you can make a lot of money, and it's just fun. It's a more exciting job, and I like it. I like where, you know, that type of pressure per se, or that type of job. So that's, for me, how I got into it.
Yeah.
So you're more upside.
Yeah. So you're upside rather than stability.
Yes.
Right?
Yes. Hence moving from East Coast to Los Angeles.
Ah. Yeah. Tell me about that.
I mean, I was working at a company called Derik Insurance Group. My dad was in insurance, super big company. Again, I'm not risk averse, so when you're doing insurance, you're supposed to be risk, you know, you have to evaluate risk and say, hey,
this conservative. It's a long way from hard money lending.
Exactly. Right? Like, what if this catches on fire? What if this? So I'm like, this doesn't really fit my skill set. So, and I always loved startups. I thought they were interesting. And my friend was living in California, one of my best friends. So I went out and visited him, and I'm like, this is pretty cool. You know, I had cousins that lived in Silicon Valley, and I liked Los Angeles. So I just kind of made the move. Didn't really have a job or anything lined up. And the first year was quite hard, obviously. Yeah. But, you know, once I kind of got on my feet, got some momentum, things started to pick up.
So you just packed the car up from Pittsburgh and...
Yeah, I was living in Cleveland. I called my parents one day and I'm like, hey, I'm quitting Zurich. You know, I just can't do it. I was 23, and you're kind of like on that, hey, I want to live a purposeful life, whatever. Like this 9-to-5 thing is not very fun. And the upside's pretty low too. So they were upset, obviously, but then a couple months later.
Insurance is the family business.
Family business, and I think parents, they don't want their kids to like jump off a bridge per se, like, and take that risk, like especially moms. I think they're mostly risk averse. So, but they trusted me. I've been pretty good my whole life, and my instincts have paid off. So, a couple months later, I ended up moving to California and just never coming back.
Yeah. So culturally, Southern California, Pittsburgh, like geographically, it's a long ways away, but culturally, a lot different.
Yeah, a lot different. I mean, there's people from all over the world that live in Southern California. It's way bigger. It's way more spread out. I think the people in Pittsburgh a lot of them are from Pittsburgh. It's not really transplants. It's kind of more straightforward, simple-minded. Southern California, there's people that have all sorts of different jobs. So people are working at different times. People are working on the weekends. There's people in the entertainment industry. They want to be actors. They want to be directors. There's people in technology. There's a ton of real estate. There's rich people, there's poor people. So it's just like, it's an insane melting pot, and everyone's on different schedules. Whereas Pittsburgh, it's kind of like, everyone's kind of living a similar life for the most part.
Yeah, it's more of a manufacturing, more of a stable industry.
Yeah, but we're actually doing a lot of deals in PA.
Yeah,
there's a lot of good deals.
Pittsburgh's hot right now.
Yeah, good purchase prices, good rents.
Yeah.
So good cash flowing properties.
Yeah. I've always. Be interesting to live somewhere where ambitious people are drawn. It changes the culture.
Yeah, there's definitely, it's interesting. I mean, there's a lot of people too that are kind of shady, I would say. Of course. But yeah, it's pretty cool. I like it. Yeah. I don't think it's for everybody.
Well, you found your way to the lending business.
Yeah.
I think give us an overview of what I use the term hard money lending. Kind of flesh that out, what that is.
So Vontiv, I mean, we call ourselves a business purpose mortgage lender. So we're lending. We've built our entire company, our loan products, our financial like our technology, our financing partners in New York and all over, somewhere potentially even in Europe now that we're talking to. all around lending to real estate investors. So we really call ourselves a business purpose mortgage company. And our loan products, one of our loan products that we do a lot of is what people call hard money, which is really just a purchase and renovation loan. So we have these value add loans. They're 12 to 24 months, interest only payments. We're financing 80 to 90% of the purchase price, and then 100% of the renovations typically on a reimbursement basis. So that's really what people call hard money. The rates are a little bit higher than conventional, or than the long-term rates. The rates are 10s to 12s per se. You're going to pay some points. You're going to pay a lender fee, but we can close in 7 days. We're not looking at your W-2. We're not doing an income verification. These loans don't go against your personal debt to income ratio. We're not reporting them to the credit bureaus, so they usually go under an LLC. So that's kind of like the hard money product, but it's really just a short-term value add loan, so you can buy and renovate a property. And then we also have the long-term loans that we've talked about. They're the 30-year loans. They're what we call a debt service coverage ratio loan, which is a lot of people call them DSCR. So it's basically we're underwriting, instead of a conventional mortgage underwrites you and your income and your spouse's income, we're underwriting the property's cash flow. So we're using that to determine the max loan amount, and we want to make sure that your rental income is above your monthly expenses, which is your taxes, your insurance, and then your principal and interest payment, so that your property's paying for itself fundamentally.
So it's underwritten based on the property.
Exactly.
And the property has to stand on its own.
Exactly.
2 feet.
Yeah, using whether maybe there's an in-place lease, so we'll use that as the market rent. Maybe it's vacant, and we'll use the appraised market rents to kind of estimate what the rental income is going to be. So in terms of loan products, we're built for investors. We have short-term loan products to improve the property. We have long-term products when your property's stabilized. And then we have a couple other loan products, like a bank statement loan, which actually are going to underwrite to your business income. Maybe you're using that to acquire a short-term rental or property where the DSCR doesn't work. And then we have some bridge products where we help investors acquire properties that don't need rehab, but they don't want to lock them into a long-term 30-year loan. They just want to get in, property stable. Maybe they're going to do a quick flip or something. I'm not sure what the use cases are always, but
it's always related to real estate. And I think people recognize that a lot of the wealth in this country comes from real estate.
100%.
But I don't know that think about why that is. Like, why real estate and not some other commodity that's creating the wealth? And I think real estate is unique because you can use other people's money to fund it. Right? So if you're going to start a shoe store, you need inventory. Well, it's hard to get people to finance inventory on shoes because it's not liquid. But real estate is so unique because you can get financing for your inventory. And there's really no other commodity, no other investment vehicle that you can do that with.
No.
Right?
Yeah, 100%. I mean, I think the financing aspect of whether you're buying a conventional or a house that you're going to live in or an investment property, financing is the key part of society. Credit keeps our economy going, loans and things like that. So I think the tangible asset behind real estate is probably, like you said, the reason why it's liquid and it's never going away. You know? We all need places to live. People are building their wealth with it, and it's pretty powerful.
That the adage that cash, like you have to have money to make money, is true in almost everywhere in the economy if you're building something from scratch. Except for real estate. Because with real estate, you can use other people's money. And create a win-win there. That's a pretty important role you guys do, is providing that liquidity.
We're providing the liquidity, and again, we're here to stay. We're playing the long game. We want you to win. We don't want you to foreclose. And coming with that is we actually, we do usually ask the investor to come in, or one of their partners to come in with some down payment. As you know, we usually don't finance 100% of the purchase price. We're, again, 80 to 90%. So we still want to see the investor or whoever is, acquiring the property have some skin in the game. But we're going to fund the majority of the deal for sure.
And so different from the insurance business, which is pretty low, different culture, right? Like low risk compared to lending on real estate, which is higher return, but higher risk.
Yeah, higher risk. I mean, Vontiv's lent, over $1.5 billion, and due to our underwriting and strategy, and our good borrowers, we've had very low default rates.
Yeah.
So luckily, we've been pretty accurate on our bets, but the risks are there, and we do have some decent standards and requirements. But I think the fun thing about real estate versus like insurance is I'll get a call from an investor on a Friday afternoon, and they'll say, "I found a killer deal. I got to close next Friday. Can you make that happen?" And usually we can if it's a purchase and renovation, especially if we worked with them before. So the quick pace and the high volatility of the industry, I think, is really fun versus insurance or corporate insurance, where it's GE is trying to line up their insurance for the next 6 months. They have 6 months to choose their policy or something. This real estate, it's high volume, it's quick. People are, in and out of deals. It's, you gotta be on your toes.
A lot of problems to solve.
Exactly.
On the front end, for sure.
It's fun.
Yeah.
I like it. We're texting with clients, they're calling us, they're talking to agents. You got the appraiser who can be accurate, who can be inaccurate. You have all these variables, and it's pretty fun.
Yeah.
Maybe your title's slow or something, or there's an issue. It's you never know what you're gonna come up with. But still get the deals done.
There's a lot of humans involved in the process.
Yeah.
The real estate technology companies have tried to replace all the humans involved with technology, and you can to an extent, but the agent, the title, there's always a important role for the people.
100%. Yeah.
Appraisers. Well, so you talk to got to be hundreds of different investors that are wanting to do various projects.
Yeah.
Right. Tell me what you see out there. What's driving those people?
I mean, I think a lot of them. So some of our marketing funnels come from, real estate influencers, as you call them. So it's these people that have had very successful careers in real estate, and now they have podcasts, Instagram pages, YouTube videos where they're educating other people about how to be a real estate investor. And a lot of that, I think, is driven by, these people look wealthy, they look cool, and they have financial freedom, and they have freedom of time. As we kind of saw earlier in the conference. So it's those things, I think, are intangibles that drive people that aren't real estate investors that want to get into real estate, because they're wow, I can make money, I can be in control of my time, all of these things. I can be an entrepreneur. It's kind of a little bit of a sexy industry, even though it's extremely hard. And if you're doing value add projects, you're getting your hands dirty. There's a lot of work. But in the long run, it's kind of sexy, and you can build this generational wealth. So I think that's attractive to people. And then that influencer or people, franchises like you, where you're helping people learn, evaluate deals, really be successful. That is what we've seen be the most successful to get people into real estate. And then once they're in, I think it's you're an investor. It's almost like an adrenaline hook. You're hooked.
Yeah.
And then you're finding deals. You want the next deal. You want the next deal. So it's kind of once the barrier to entry is broken, it's oh, let's keep going. Let's make it happen. And then for us as a lender, we want to be reliable, repeatable, predictable, and easy to work with, so that you as an investor can go find your deals, negotiate with sellers, manage rental properties if you have them. And then the financing is not hard. You can do a loan application in 3 minutes.
Yeah.
You can call Derik. I've already talked to him a million times. He's getting me quotes, evaluate your quotes, choose a product, do a couple tasks that we need, and then focus on your other stuff.
So you see you see a lot of people that are attracted to the industry. They've watched influencers. They have an idea about what this business is like.
Yeah.
What surprises them?
No free money. There's no 100% financing usually. We're not going to lend to, like, let's say the property's worth $200K on an appraised value and they're buying it for $150K. We're lending to the purchase price. We're not lending to the appraised value. So like sometimes people think that, hey, I'm getting a killer deal. I have all this equity that I'm capturing right away. Can you lend me to that equity and I don't have to put any money up? So I think just like the 100% financing is surprises people. We still do look at your credit score. You know, we want to make sure that you know how to pay your bills and things like that. Sometimes that catches people off guard because they're like, oh, you're hard money. It's like, maybe there aren't lenders that don't, but we do. But if you qualify, we're easy to work with, things like that. So looking at your credit score, 100% financing, and then two, like winning a deal. That's what we hear most. Like obviously as the lender, we're not really a part of the actual negotiations or if they win the deal or not, but we allow people to submit for loan quotes and we have a lot of conversations before the property's under contract. And most of the time that we lose a deal, it's not because they go with another lender. The buyer, the investor actually doesn't win the deal with the seller.
Couldn't close it.
So a lot of people, we hear a lot of newbies, they're like, wow, this is hard. This is really hard. And I have guys that have closed 50, 100 deals and they say it's hard to win a deal right now. The inventory's light. So if you're brand new, it's going to be, pretty hard to win a deal too.
Yeah. There's a sales component to it, right? It's not just about the houses. And one of the things that surprised us is you assume everyone has some sales skills. It's not necessarily the case. People like yourself who have a sales background, you take that for granted.
True. It's true. There's an art to it.
Yeah.
But it's what the gentleman was saying too on that panel, just human connection. Like if you have a seller that's under foreclosure, like sales is really just, being able to relate to that person, understanding what their needs are, what your needs are, and then coming to some sort of agreement.
Yeah. How important do you think empathy is?
Very. I think it's very important, especially in this volatile industry that it is. There's nothing that we like less than working with an investor that's kind of an a-hole and just like do it like this or this. It's like, it's not fun.
Yeah.
So I think we make mistakes as a lender. Sometimes there's friction. Nothing's perfect. So if you give us empathy, we know that, as a borrower, you might not have your ducks in a row always, or something might, screw up in the deal. So we have empathy to you. And then I'm sure when they're negotiating with the seller, empathy is extremely important because the seller could back out at any time. So it seems to be in our industry really important.
Yeah. Just understand.
And I was just going to say the last thing on empathy too is a lot of these people, which you guys know, people are working, you're doing multiple deals with somebody, whether they're a contractor, they're your agent, they're your lender. You're probably going to do, like, if you're an active investor, you're going to be working with them all year. So if you're not portraying empathy, they won't want to work with you all year. And you're going to have to get new teams, new processes, and that's a headache.
Yeah.
It's hard to scale that way.
Yeah, to have those sustainable relationships, you got to align interests. And I think that requires empathy. You've got to look at it not just from your own selfish perspective, but like, I've got to make it a win for you as well. And that's where it seems like that's where the art is.
Right.
And for sellers, it's certainly the case to try to understand their perspective and create a win.
Is that something that you think about a lot as an investor?
I think people have natural levels of empathy. I think you're born, like, some people are just naturally more empathetic than others.
True. Yeah.
I think it can be it can be a double-edged sword. Like I think it's valuable in ways. You can also get emotionally attached to deals and other people's interests and stop looking at it objectively if you're an empathetic person.
So you're saying you almost go too far.
You can, yeah. I think teachers good teachers tend to have a deep empathy because they can see it from a student's perspective. Which is really valuable for teaching.
Yeah, because you've been there before.
Yeah, and I've always felt like I've always been naturally empathetic, and it's helped with teaching. But it does create blind spots.
Yeah, I guess so. I think in sales too, speaking of just general sales, it's like if I didn't sell these real estate products and wasn't successful doing that, it'd be really hard to build a team that I oversee now of 5 or 10 people that are also selling loans to real estate investors and being advisors to investors and being their financial partner. If I didn't do that, I wouldn't have that empathy and knowledge to lead a team or help them solve problems and things like that. So sometimes it helps too. Just having done it, you naturally have empathy because you've been in their shoes, like you said.
Yeah, right. What do you look for? What do you look for in people that you hire? Have you found qualities that you look for?
I think we're kind of a high growth startup, so it's like kind of not the most stable thing. It's pretty intense, and we want A players. So for us, probably will is like one of the most important things. Like, how badly do you want to work, be successful, be part of a fun company that's growing? Like, what's your intentions? Because you want to make sure that lines up with what Vontiv's trying to build and do, versus like, again, maybe you should work at like a company that has 50,000 people and kind of plugging in, and there's nothing wrong. It's a different type of job.
Yeah.
So like will and willingness to work in this environment, and then so that's like an intangible. And then the ability to understand finance. I mean, these loans, loan to cost, loan to value, loan to purchase price, loan to ARV, interest rates, points, things like that. There's a lot of numbers involved.
Yeah.
And so you have to understand math and finance.
Yeah.
What's a good deal? We don't want to lend on a property where the costs of the property, of purchase price and renovations are over 95% of the ARV. That's one of our like max constraints where it's like, whoa, this might not be a good deal.
It doesn't leave much room for success.
Exactly. So like you have to understand those nuances. So I'd say the ability to understand financial products, and then just like culture fit, which is kind of hard to describe, but you kind of know. But sometimes you take, sometimes we hire fast, fire fast. Doesn't work out. It's not good for them, not good for us. And then the ones that or the ones that seem like it's going to work, they work themselves out. So
yeah, these deals are, we say we try to turn a deal into a math problem because it's easy to get emotionally attached to a deal, especially when you get to know the seller, you get to know the house, you get emotionally invested in it.
So those are the things that keep you?
But it's the math. Like the math has to work. And so we try to take a lot of that emotion out with turning it into a math problem. But it's never just a math problem because there's people involved. And so there's art to it as well. But the math is kind of the guardrails to keep us from getting ourselves in trouble.
Got it. Yeah. Now, when you're looking at the math, I'm curious because we have different investment tiers when we're doing our short-term value add loans. If you've never done a purchase and renovation, we're going to be at lower leverages and a little bit of a higher rate, and you have less room to do what we call like complex rehab, which is like your renovation budgets exceeding your purchase price, or you're moving load-bearing walls, you're taking down, you're adding square footage. Like those things are, looked at a lot with newer investors versus very experienced. How do you look at it obviously as an investor and all the other investors that you work with and you're helping coach them? Like, how do you think about some of these rehab projects?
It depends a little bit on capacity, and there's a lot of different ways to add value to a real estate project. We really try to add value with construction. And the reason we focus on construction is because you can add value in construction in any market. It has value in any market. Like the adding value to create deals or to market, it kind of comes and goes. Whether in a hot market it's really valuable, in a slow market, like not so much. But there's like when you look at the housing stock in this country, it's really old. It's getting older every year.
Oh, interesting.
We're not building.
Yeah.
We're not building. We haven't built any new affordable housing since the 1970s. So now our housing stock is old, and it's got a lot of deferred maintenance. It needs a lot of investment in it. So there's a lot of opportunity.
Yeah.
Right. And so we've really leaned in on how can we add value with the construction. So we seek out larger construction projects because there's more opportunity to add value to it.
The higher upside.
Yeah. But it's difficult. Yeah. Like it's really, really difficult.
Yeah.
So
and maybe stressful.
Stressful, yeah, because you've got to manage that construction ecosystem, contractors, and so it's messy. It's messy work, right? And so I imagine when you see guys getting into this business, they look at the numbers, they turn it into a math problem, and say it's a $90,000 construction budget, and those numbers work. How surprised are they at how hard it is to execute a $90,000 rehab? And what risk, how do you guys evaluate the risk of that?
We're doing it a lot on the front end before we close the loan. So, when they do the submission, we have certain criteria, and then we have an underwriting process where we're evaluating the scope of work and, evaluating the borrower, the property, and all those things. So we're trying to do as much on the front end as possible. But looking kind of at your credit history, your credit score, do you have liquidity for 3 months of interest payments? Do you have liquidity to get the rehab started, maybe 20% of the rehab budget? So we make sure that they've proven that they've, are a good borrower via their credit score. They have the liquidity to take down the deal, get the rehab started, make some monthly payments. And then we have an appraiser go out there and, sometimes they're in line with the investor's thoughts and our thoughts. Sometimes they're not, and we have to find the right point. But they'll say, hey, this is probably what the ARV is going to be. And then we have a 70% or a 70 to 75% loan to ARV maximum. So we're kind of protecting ourselves there, where we're not going to lend more than 75% of the ARV. So we're doing it mostly on the front end, and then once the project gets started, we're hoping the investor executes, and we have a draw process and things like that. But we're pretty hands off after the loan closes, besides when they're doing a draw. So it's kind of up to them. But because they're entrepreneurs, they're usually able to make it happen. Yeah. But I don't know how stressed or how hard it is for them during that process.
So in your underwriting, you're checking to make sure their math is good math.
Their math is good math. And then, things, again, they have the liquidity to take down the deal. Yeah. The property doesn't, have any cracks in the foundation, and you weren't planning on rehabbing that. We kind of do that stuff. And then just kind of their background and stuff like that.
When it goes wrong, what's the most common culprit?
Underestimating probably the renovation costs, or uncovering something during renovation that was totally unexpected. Our scope of work that we have clients fill out, we make them at least do a 10% contingency. So whatever the rehab budget is, there has to be a 10% contingency, because we know things are going to pop up and you're going to need that money. Maybe it's for one thing, maybe it's for a bunch. So we let you go up to 20%. So ideally the contingency can help, but it's mostly unforeseen problems during the renovation, and then mismanaging that, or your contractor, maybe you've never worked with them before and you didn't get a referral, and they kind of overestimated the bids, and they kind of built that into the budget, and it ends up costing you too much. So that's what we've seen. And then also too, and that's something I wanted to pick your brain on, is there's things that investors say, oh, I added this, and I added XYZ, and the kitchen is this layout. And sometimes those are preferences versus things that make the ARV go up. Yeah. So that's why I wanted to ask you too, is how do you know that the rehab's going to make the ARV go up rather than like, oh, this is actually just a preference that some
Yeah.
buyers will like versus others.
Yeah, especially in the age of Instagram and HGTV.
Yeah.
Like you can think the preferences add value, and they actually don't.
Yeah.
Because you do, at the end of the day, the appraiser has a say, right?
Yeah, big sense.
So when you go to exit, that appraiser is, just because a buyer appreciates your finishes and preferences doesn't mean the appraiser will.
Yeah.
And so appraisers are very much about the square footage, right? And so
Number of bedrooms.
yeah. So it goes a little bit back to empathy, because the math is different. Like there's so many different players over the life cycle of a flip project. You know, you've got the seller at the beginning, and there's math there that the seller's doing. The contractor has certain math. And then, but you've always got to, and the lender, you guys have certain math that you bring to the deal. But then probably the person whose math is most important is the appraiser at the end of the deal. So as an investor, we got to like be empathetic and consider all of those perspectives.
Yeah, which is hard.
Yeah. And if you get, if you don't satisfy the appraiser's math, and you find out at the end of the process. We've done a lot of thinking about that, because one of the things we find is people overcomplicate the rehab.
Interesting.
So those preferences, it's not just the cost of the materials of that. It's adding another layer of complexity for the contractor. And what we found is that's more expensive than the material.
And it doesn't always correlate to ARV.
Yeah. So
increasing.
Right. So tile is a good example. You know, the cost of tile is probably negligible. But the real cost of tile is what all ripple effects does it have to put in tile. You know, what wrinkles does that create? What complexity does that create? What does that do to your timelines? And
interesting.
And people don't always value. They don't always value that.
Yeah.
And the other thing is that we found over time is when you replace something that is there, it has functional value. So say it's older cabinets.
Okay.
That are solid. And you're trying to decide, all right, am I going to upgrade those cabinets? And is that worth the investment? Does it add to the value? To add new cabinets, you have to take away the cabinets that are there. Well, those cabinets that are there have functional value. So you're going backwards by taking those out, right? So you're taking that value away, and now you're putting in new cabinets. So you're taking 2 steps backwards. So now you've really got to have a value add.
I see what
Does that
you're
make
saying.
sense?
Yes. Yeah.
And so
Is there a number that makes the like?
Yeah, it really depends, and that's where the art of it
2x.
is. Yeah, it's like it's not math that can be done on a spreadsheet necessarily. And so people's tendency is to replace everything, the personal. But we've really started thinking hard about what can we preserve? Like, what of that functional value can we preserve, and then add value around it? Because affordability is so important, and it's not just about what your buyer wants. It's like, what can your buyer afford?
Good point. Yeah, they were talking about that in the sessions today. It's like once you get over that 350, 400, 500, it's your amount of buyers is totally decreased.
Yeah, especially in this environment with increased rates, affordability is important. But it goes back to empathy. Yeah, like you got to understand the perspective of the buyer. So, can they afford those upgraded cabinets in this price range? garage?
Right.
Or does it price them out of this house?
Doesn't matter to them. I think some of the best ARVs and some of the best results that we've seen for investors is like taking a unfinished part of the house
Yes.
and making it finished, like a
Yes.
basement or a third
Yes.
floor. Those ARVs are always either higher than they're projected or spot on some of the deals that I've closed recently, where they're actually coming back to us on the exit and we're doing a long-term 30-year DSCR loan for them because they want to hold on to it. That's where I'm seeing the ARVs win and people really getting those good numbers, is taking it unfinished and making them finished.
A lot of opportunity there, or finishing out a garage.
Okay, yeah,
Finishing out a basement. And we've seen a big difference in that since COVID, since the price run. Because before COVID, your dollars per square foot were much lower. And so just the math of it makes it harder to justify adding square footage when your dollars per square foot sales price is lower. But now, after the run up, it's a lot, like there's a lot more ROI. There's a lot more meat on the bone to create new finished square footage.
Got it.
So we've seen a lot more opportunity in the past 2 years to do that.
Focus on that.
Yeah. Got some projects going where you take it's a one story, it's in high price markets, and turn it into a 2-story and add square footage there.
Oh wow, that's really nice. Are you guys doing any? There's some hype around ADUs and things like that. Are you guys seeing that? Or doing that stuff? It's tough.
I'm really interested in that. And that is so specific to the local jurisdictions.
Yeah.
And it seems like it's the codes officers and the city codes departments that are really dictating whether that makes sense or not.
Yeah.
And I know in California has been really aggressive on ADUs. And they see that, they've really leaned into that as a solution to affordable housing.
Absolutely, yeah.
Right?
California and then Seattle, where one of our headquarters is at, is pretty aggressive on it as well.
So those states have a reputation for being highly regulated, but they actually are the opposite when it comes to ADUs. And so I'm seeing a lot of that, a lot of aggression on that there in the West Coast. The East Coast has been slower.
Yeah. You have more land.
Yeah.
Honestly.
Yeah. And I think there's more of an aversion to density.
Yep.
That's a big, especially here in the Southeast. Like local politicians are really slow to approve density because Southerners have an aversion to
Which is
like our privacy, right? That's why we live here.
Yeah, people want big yards. Yeah, I grew up in a nice yard.
Yeah, but like, how are we going to solve the housing crisis and the housing shortage if we don't increase density? But ADUs are super interesting. How do you you guys lend on?
We do. We want to see that you or your contractor have done it before, because you're building something out of nothing. It's almost like a little new construction project. And you need some money to put up because if you're going to acquire a property, renovate the property, and build an ADU, I mean that's a fair amount of money. So usually what we see people do is they either own the property already, and then we'll refinance their current property, and then they'll build an ADU with that cash out refinance or something like that, or we'll help them fund it. They're doing it in 2 steps, or they're acquiring the subject property, renovating it, getting that appraised, and then maybe cashing out and then helping them build the ADU. But to do it in one go is you need a lot of money and you need a great team. So it's pretty complex, but we're seeing them. People are doing them. It's just a hot trend that people keep calling in and talking and wanting to ask us about. And I was curious to get your take because it's hard to execute, honestly.
It makes more economic sense in high dollar areas where dollars per square foot's higher. It's not the most efficient because you're building, maybe a 400 square foot. It's still got the high priced items. It's got a kitchen, it's got a bathroom, and so the dollars per square foot on construction is pretty high on them. So it's got to have it's hard to get that return unless it's a high dollar area.
Yeah, and then most of the ADU strategies, it's so people can, almost double their rent because they're properties that they're renting out. So it's a long-term play to get that extra cash flow every month because you got someone paying $1,000 a month on that ADU that you wouldn't have been getting. So it's definitely a long-term play, but it's pretty nuanced.
Yeah.
A little complex, but I think something that I wanted to ask you about too, that and kind of talk about that as a lender we're trying to help out too, is like your guys' theme right now is elevate your game, elevate your results. And as a lender, internally we want to elevate and be better so that we're growing. But like our goal is to be a financial partner so that investors can elevate, they can scale. Like you said, you can use other people's money. So I think what we do hopefully aligns with your guys' goals too, and elevation and to grow and scale and be better, and having a financial partner to rely on, I think is important.
Yeah, the scaling of this business is tough because it typically requires cash. Like the rub is that lenders want skin in the game.
Okay.
Right?
Yeah.
Like you want us to have some skin in the game.
Yeah.
But then to do it well, we need to do more than one project at a time. Like we need to do some quantity, because it's really, what we found is it's really, really hard to just do one house, because you can't create any competitive advantages when you just have one house.
Like economies of scale.
Yeah. So you go back to that where we add value with construction. It's an $80,000 rehab on average. Well, you've got a contractor who's adding that value, right? If you only have one house, you don't really have any kind of control over that contractor. You're just another client, and you just don't have any long-term control. So probably not going to prioritize you. They're probably going to prioritize other people.
I see.
Whereas if you can scale this business and make it bigger than one house, now you have more control over your partners. It's a long-term relationship rather than a transactional relationship.
So you're telling your contractor, hey, we have 3 that we're doing right now. We're tied at the hip here.
Yeah, right. And they know when they finish this one, there's going to be another one. And it creates a long-term relationship rather than just a one-off relationship. It's so hard. There's so many people involved in a flip. It's really hard to do that with transactional relationships. But that's the hard part. If you have to have cash in every deal, it's hard to do multiple projects.
Right. Yeah.
So that's the rub, and then trying to find that balance.
Yeah, that's why, a lot of our deals, we lend to LLCs. Very rarely is it a sole member of the LLC. There's usually people are partnering up, as you know. So that helps people kind of get going quickly, or have some second opinions, or add more liquidity to the project and things like that. Is finding a good partner that you're going to go into these deals with.
Yeah, it's you can't do anything big by yourself.
No.
Like to do, and I'm sure it's true in other parts of the economy too, but projects are so specialized, and creating competitive advantages in any industry is so difficult. You've got to create collaboration with partners, and figuring out how to align those interests is an art to that.
It comes back to your empathy. It's like in every conversation, fundamental, but it comes up again here.
Yeah, I assume. Yeah, you can't do anything big by yourself.
No way. Do you guys do? We're starting to see some success. You have to have experience, or someone has to have experience. But ground up construction. Yeah. You guys do any of that, or have you tried that? It's pretty nuanced, but there's some money to be made.
Yeah, we've got some pretty good projects going on the new construction side. We've got several of those projects going in Nashville.
Oh, cool. Hot market.
Nashville's a hot market. So every square foot is valuable in a place like that. But other places as well. It's just a different. It's a different skill set. It's easier in some ways. It's more predictable in some ways, but then it's more risk in other ways.
Yeah.
Your cycle times are a little bit longer.
What's your ideal cycle time? For us, our loans are sometimes we'll do 6 months.
Yeah.
It's like a more rare scenario, but usually it's 12 months, no prepayment penalty. Sometimes 18 months, but so no prepayment penalties. Whenever you're done, you can get out of the project without a penalty. But what is your guys' ideal when you're doing your deals and your team? Like
It's
timeline.
It's changed over the last few years. If you'd have asked me a few years ago, our projects were smaller.
Okay.
But as the market's changed, the deals that we can add the most value to are the bigger construction projects.
Right.
Because less people can execute on those. Well, bigger construction budgets require longer time. And so our cycle times have increased because we've increased the scope of the deals that we're buying.
Yeah, of the renovations.
Yeah, if it's a simple, like, people talk about carpet and paint flips. Those are unicorns that I don't see, because if it just needs carpet and paint, put it on the MLS and sell it. You don't need us.
Right.
Right.
But
I still hear people talking about those. I don't.
they found the killer deal.
It's a unicorn I haven't found yet.
Yeah. We get those calls all the time. I have a killer deal. I have it. It's the best deal on the market.
Yeah. It's more likely it's bad math, right?
Yeah.
Because a house, your typical house in America, it goes back to the housing stock. Like, most of the houses were built in the 50s and 60s, and then we stopped building them in the 70s. Mm-hmm. So these are houses that are 60 years old now.
Damn, yeah.
Like, they need more than carpet and paint.
Right.
Like, the plumbing, the electrical, the HVAC, and you can't just paper over that stuff.
Mm-hmm. The roof.
Yeah. And so those get into high dollar projects.
Makes sense.
That take time.
Yeah,
and extend those cycle times, which makes it more challenging.
Mm-hmm. Yeah, and then for us, our 18-month loan product and our 12-month loan product, so you get 6 extra months. Again, your rate goes up like a quarter point. It's very low consequences. So when we see more complex rehab, we're kind of recommending you're better off. You don't want to worry about an extension, X, Y, Z. Take an 18-month loan if you're doing heavy rehab, and your rate's a quarter point higher, but so be it.
That time can be valuable. Rehab, you don't know. Like, the more you do it, the more experience you have, the more predictable they get. But they're not. It's art and science.
Yeah, and kind of from your guys' mindset too, it seems like you're proposing or coaching more for the burr, or to building and holding onto these assets and building wealth that way. Yeah, is that kind of, you've been leaning into that?
Yeah, we've been historically really focused on flips, and in the market from 2020 on, like, it makes sense it's made sense to flip everything because the market was so high. But we are really shifting to do a lot more buy and holds. Mm-hmm. And a flip, you have to add all of the value in a 6-7 month cycle. Well, that's hard. Like, there's a lot of pressure for that. Not every house a lot of the houses we look at, it just doesn't make sense because we can't add that value in such a short amount of time. But then when you think about a buy and hold, now you're adding value over 10, 20, 30 years. Mm-hmm. It's just a different perspective that you have to come with those deals. Mm-hmm. And so if you can add value with construction, there's a lot of different exit strategies.
Right.
On the reverse side, if you can't add value with construction, like, your options pretty limited.
Yeah. You're underwater probably.
Yeah. But that's the hard part, right?
It's true. Yeah. If it was easy, everyone would do it. Sometimes I'd say that to clients all the time. Like they're complaining or they're like, oh, this or that. It's like, well, if it was easy, everyone would do it. And that's really anything in life. But being a good investor, you got to be organized. You got to be proactive. You got to be smart. And you got to be a problem solver. Like those are the 4 things I've seen in all of our deals. Is those people, and you can't complain. Like people that just complain about everything.
Say those one more time. Like
you got to be proactive, meaning like whether you're working with us as the lender, like if we need documents from you, you're timely in getting those documents, so you're not screwing the deal up. If title needs something from you, you're getting to them, and then you're also just asking like, hey, like you're just on your stuff. That's what I mean. Like you're responding quickly. You're bringing things up before they become problems, things like that. I think it was you're proactive, you're a problem solver. Problems come up, you can't complain about them. You can't, it's like, let's figure out how to get them done together. Don't complain to me. I won't complain to you. Don't complain to the seller. This, it is what it is. We got to solve that. So I think the proactiveness and then the problem solving have been really important. And then, as you said, empathy and being able to work well together and being resilient as well too, because these things are tough. So you have to show some resilience and some patience because it doesn't always go your way. I think too.
Resilience and perseverance. The older I get, the more I value those qualities above any other. Above any other qualities.
100%. And there's the kind of famous saying by I forget what his name was, but he just says like when anything happens, you just say good. Like this got messed up. Good. All right, problem solved. Like if that becomes your mindset, where you just saying good, it's you actually are able to just go further than you would have. So that's kind of something that we try to adopt internally on the sales team. Vontiv is like good. Everything is good.
It's it's an opportunity to solve a problem.
Yeah, exactly, or grow in some way, I guess.
Yeah. Well, cool, man. Derik, thanks for being here.
Thank you. This is a pleasure.